Hello, and welcome to another episode of the Market Snapshot series. My name is Rufas Kamau, Markets Analyst at FXPesa. So today, we'll be looking at a couple of things. One is the top events that are expected for the day on the economic calendar. We'll also be discussing what happened yesterday during the FOMC press conference. And then later on, we'll be looking at the charts. Majorly, we'll be looking at the currency measures. We will be looking at the price of gold, price of oil, US top equity indices, as well as European indices to try and understand the current market structure, the key price levels, and potential market opportunities. So once you join in, kindly say hi on the live comment section, and this will confirm that everything is working just fine. So hello, I can see Ambrose in the house, Matilda, good morning, Gas Boys TV, Philip Derrick. Thank you guys, thank you for joining. So let's get things going. So first things first, we start with the economic calendar. Let me try and share this. So clearly, this week has been quite an adventure, having seen quite a number of things changing or being reported way above or below expectations. I think the key highlight of the week is the interesting decision by the Bank of Japan to hold the interest rates level, but then adjust the upper limit of the yield curve control from a hard cap of 1% to a flexible cap of still 1%, meaning that yields can be allowed to move above 1%. So then later on, we had GDP in Canada coming in at 0.0%, same as the previous reading, which basically indicates economic weakness in Canada. Then we had a strong CB or Conference Board Consumer Confidence Survey in the US at 102.6, slightly below the previous reading. Job market slowing down in New Zealand and unemployment rate rising from 3.6 to 3.9%. ADP non-farm employment change missing expectations, but still increasing to 113K from the previous reading of 89K. Then job openings increasing to 9.55 million from the previous reading of 9.50, which was way higher than the expected number. And then, as we had always expected for the entire month, that the Fed would potentially hold interest rates at the current level. It was confirmed last night at 9 p.m. that the Fed chose to hold interest rates at that level. So the most interesting point was that Jerome Powell said that they are not considering any rate cuts anytime. So in this case, there is this perception in the market that interest rates could remain way higher for longer. And in this case, the Fed also acknowledged that the labor market had somehow stabilized. And at the same time, the Fed acknowledged that the US economy is pretty strong. And these had a couple of ramifications in the markets. So today, we are looking at a CPI from Switzerland, which came in at 0.1% as expected. And this is an improvement from the previous reading of negative 0.1%. So the most important news for the day, besides the S&P Global Manufacturing PMI for European economies, that is Spain, Italy, France, and Germany, followed by the final manufacturing PMI, which will be reported at midday, we will be majorly focused on the Bank of England. So I remember the last time the Bank of England met, there was a tricky balance of 4 versus 5 members choosing to hold interest rates level. So in this case, 5 members chose to hold interest rates at 5.25%, and 4 members chose to go for a rate hike. So since the 5 were majority, then they settled on the decision to have 5.25% interest rates. So the speculation today is that 7 members vote on another decision to hold interest rates at the current level, while 2 members will be expected to be voting for a rate hike. Of course, the 0 represents the members voting for a rate cut. So in this case, following what we have seen with the ECB holding rates, Reserve Bank of Australia, Reserve Bank of New Zealand, all holding interest rates. And yesterday, the Federal Reserve Bank of the US FOMC committee choosing to hold interest rates, we could be expecting something similar in the UK. So if the MPC, or the Monetary Policy Committee in the UK, decides to hold interest rates level at 5.25%, then the focus will be on the speech that comes later after the announcement, and this will be at 3:30 p.m. So immediately after the announcement of rates, or 30 minutes later, there will be a press conference about the interest rate decision at the Bank of England in London, and it will be presented by Bank of England Governor Andrew Bailey. So on this speech, investors will be looking for a couple of things. One is the outlook on the economy. 2 is the monetary policy outlook. So if the Bank of England governor seems more hawkish, basically implying that they are looking to do any more rate hikes, then in that case, it could be very positive for the GBP. On the other hand, if he's considering any form of rate cuts, especially in early 2024, then in that case, we could be seeing the GBP weakening further. So this will be an interesting development, especially if interest rates were to remain at the current rate. On the other hand, if there's a surprise rate hike, let's say, for instance, somehow or wildly, the Bank of England chooses to hike interest rates to, let's say, 5.5%, then that should be pretty strong for the GBP. And we should be expecting the UK pound to be rallying against other currencies, especially the weaker ones or the ones with the lower interest rates, such as the Japanese yen. So a key currency pair to be observing would be the pound yen, especially if the pound was to strengthen. And of course, if it were to weaken, then pound USD would be an interesting pair to think about. Of course, we'll also be going through the monetary policy summary and the monetary policy report before making any decision to trade. So later on, after the UK data, we'll also be focused on the weekly unemployment claims in the US ahead of the non-farm payrolls on Friday, which is tomorrow. So in the previous reading, it was 210K. That is last week. So this week, we're expecting unemployment claims to remain the same at 210K. So later on in the day, we'll be having natural gas storage data. And then the SNB Chairman Jordan will also be speaking, and this will be at 8 p.m. So he's due to participate in a panel discussion titled Perspectives on Central Banking and the Global Economy at the University of Zurich. So then after we're done with today, tomorrow morning session is expected to be a little bit slow because there will be a bank holiday in Japan in observance of Culture Day. So we will be expecting low volatility in Japanese yen pairs or low liquidity, majorly because a majority of the banks in Japan, actually all of them, will be closed for the holiday. So we'll be getting Kaizen services PMI from China and Reserve Bank of New Zealand statement of intent, and this will be just past 4:45 a.m. Then as we approach the end of the day, we'll be having first at 1 p.m. unemployment rate in the Eurozone, final services PMI at 12:30 for GBP, and then most interesting news will be the non-farm employment change, where in this case, we're expecting a slowdown from the previous number, which was 336K jobs down to 179K jobs. So average hourly earnings are expected to have increased by 0.3% in October compared to 0.2% in September. So these 2 data points will be very important in determining market direction. Then we end the week with ISM services PMI for the US at 5 p.m. So clearly today, we don't have much to look forward to. Only one major data point, which is the Bank of England monetary policy decision on interest rates. So knowing that, now it's time to dive a little bit deeper on what the Fed decided yesterday. So Fed officials have said they are proceeding cautiously as the central bank mulls future actions on interest rates and takes more time to digest cooling inflation data and judge whether hotter than expected consumer spending and job growth could continue keeping inflation higher for longer. So the Fed is a little bit concerned. Yes, they are waiting for the rate hikes that they already implemented to take their full effect in the market. But at the same time, they're experiencing quite a number of challenges. One, we saw the economy or the GDP growing faster than expected. In the month of September, it was more than double the previous number on August. Then job growth is consistently high from the JOLTS job openings that we saw yesterday. We saw that there's more and more job openings happening in the US economy, which basically implies that the economy is expanding and employers are looking for more and more employees. So wage growth is also rising, and that's quite a problem. So when you have higher wage growth, higher job growth, higher economic growth, then the overall expectation is that we see consistently higher inflation. So at the same time, the rising oil prices are quite a challenge because they are exerting upwards pressure on inflation. So at some point, Jay Powell may have to decide on whether to continue hiking interest rates or not. So for now, they decided to hold, but maybe in the next 1 or 2 meetings, we could be seeing yet another rate hike. So given the resilience in the economy, Powell has warned that persistently above trend growth or continued strong job growth could put further progress on inflation risk. So he reiterated those warnings on Wednesday. Slowing down is giving us a better sense of how much more we need to do if we need to do more, Powell said in his press conference yesterday. So new spending data out of September showed consumers are spending more than they are earning. Adjusted for inflation, consumers increased spending in each of the last 3 months. Real disposable income fell over the same period, raising question of how much longer spending could last at these levels. So what they're basically saying is that the average US consumer is spending more than they are earning and basically getting into more and more debt. And this is quite a challenging issue. And the overall expectation here is that as people get more and more into debt, at some point, this will reduce their disposable income and spending will reduce, basically leading to much lower inflation. However, this doesn't seem to be the case. So over the last 3 months, consumer spending has just been increasing despite people getting into more and more debt, especially considering that we are in a high interest rate environment. So meaning inflation, based on the Fed's favored gauge, the personal consumption expenditures index that excludes the cost of food and energy, or so-called core PCE, showed that prices rose 3.7% over the prior year in September, in line with where officials expected inflation to end of the year, offering the prospect inflation could end 2023 below where the officials had expected, meaning that inflation is in line with the Fed's expectation. So the public does believe that inflation will get back down to 2% over time, Powell said on Wednesday at his press conference, and it will. They are right. There is no real crack in that armor. So knowing what we know, then there's this overall expectation that interest rates remain high, and with high interest rates, then it's time to think about the market reaction. So yesterday, after the announcement of the data, you can see the big sell-off that followed after, meaning that the dollar index continued losing towards the end of the day, erasing all the gains it had made earlier. So there was this expectation that the Fed could go for a hawkish stance, basically indicating further rate hikes. But since this was not indicated, then that explains why we had a sell-off. However, looking at the overall picture, with US interest rates at a range between 5.25% and 5.50%, then bond yields remain significantly high, and this basically leads to a much stronger dollar. So despite the big sell-off that happened yesterday, today I have the expectation that the dollar will start recovering, and I think that has already started to play out. So if you look at the 5 minutes chart and see the price action since the beginning of the day, Then you can see it was relatively arranged. And now what we are seeing here is a market that is basically looking to break towards the upper side, meaning that the dollar is now strengthening against other currencies. So if you look at the majors, there was a big rally in the pound USD yesterday as the pound continued gaining against the weaker dollar. But then you can see since this morning, I would call this the Tokyo session. We have seen the pound starting to weaken against the dollar as the dollar recovers the losses it had made. So it's the same thing across board. We are seeing euro making a very good rally against the dollar, pausing for a moment. And now what we are seeing as we enter the London session is a big sell-off happening here, meaning that the Euro USD is changing direction and the dollar is finding its strength back. So in USD JPY, you can see how the dollar continued losing, found some bottom here at 150.142, and now is seemingly looking to rally again. So the bottom that we saw here is quite an interesting level because at some point it was acting as a resistance, and this is only a couple of weeks ago, around the 3rd of October. So in this case, previous resistance is now serving as support. And of course, we know that early this morning, Japan announced a new bill, more spending to basically address inflation, which is quite staggering because we know that you cannot solve inflation by implementing more spending. So I think we can Google this quickly. All right, so I found the page here. So you can see the headline here. Japan unveils $113 billion package to caution inflation. So Japanese Prime Minister Fumio Kishida said on Thursday, the government will spend over 17 trillion yen on a package of measures to caution the economic blow from inflation, which will include tax cuts. So to fund part of the spending, the government will compile a supplementary budget for the current fiscal year of 13.1 trillion yen. So including spending by local governments and state-backed loans, the size of the package will total 21.8 trillion yen. Japan's economy is seeing a big opportunity open up to shift a new stage for the first time in 3 decades. As it exists from a deflationary spiral, Kishida told a meeting of government and ruling party executives on Thursday. So the idea here is that this is something we have seen before. So at the height of inflation last year, the Bank of England basically did the same. So they decided to intervene in the economy to caution people against inflation. So while energy prices had gone up, they injected cash to support people. So people would get subsidized energy bills, and these helped people survive the high inflation environment. However, UK remains as one of the top economies with the highest inflation rates, and this is as a result of even more spending from the government. So the US also did the same. Whenever inflation was high, they passed a new spending bill that would be destined to help caution people from inflation. But then that spending bill ended up adding to inflationary pressures because we all know that inflation is caused by an increase in monetary spending or the monetary supply. So when there is more money in the system, then you expect higher prices overall, leading to high inflation. So in this case, I don't think this will solve the Japanese issue of high inflation. Yes, it may help caution some sectors in the economy, but it doesn't address the underlying problem. So judging from this, and now looking at the charts, what we are seeing here is the USD losing to the Japanese yen yesterday and early this morning. But then we have seen quite a strong bottom applying here. The market retesting this area again. And now I personally expect the market to now start the journey towards recovery and perhaps retest the previous high. So overall, when you look at the fundamental factors affecting both the US and Japan, you'll notice that the wide divergence between the two central bank policies is still very much prevalent, and this leads to the assumption that the dollar will continue recovering against the yen, and this pullback is very much welcome for any trader who is on the wrong side. So on the other hand, as I've always been saying in this currency pair, you have to be very much concerned with what might happen if the Bank of Japan decides to intervene in the currency market. So remember, all previous interventions over the last 2 years have happened at levels above 150. That is 150 JPY for $1. So the first one we saw here was around the 21st of October last year. Then we had a couple of interventions happening earlier this year. And the first one was here. This was on the 3rd of October this year. The second one was right here. It didn't have much effect. This was on the 26th of October. And now, even after those two interventions, we are seeing price closing higher than the Bank of Japan was intending, which leads to more pressure to intervene in the currency market. So as for now, the overall direction is up. We expect the USD JPY to continue rising. But then if any intervention happens, then we trade back downwards. So for Euro USD, there was a good rally. Now it's sideways momentum. So the potential for a reversal is quite potent. So you have to be just patient and wait for the break to happen conclusively. For USDN, we saw the big sell-off yesterday, and now we are seeing some pretty nice bottom. So in this case, if you are using this area as a support, then you can notice that for the last 5 trading days, this has been a major support for USD CAD. So in this case, we expect the price to be bouncing strongly and moving back towards the previous high, which is basically yesterday's high. So in this case, the potential for USD CAD trading back higher is quite potent. We just have to observe for strong evidence of bullish entry. So as for gold, we are seeing quite some form of resilience after breaking towards the lower side. So notice how this trend line was holding. The market kept bouncing from this trend line and going higher up until early in the week when it formed a high that was significantly lower than the previous high. So this led to the potential for a breakout towards the lower side. So the breakout eventually happened here. The market kept going down. Then on Wednesday, we continued with that bearish momentum before the market made a recovery. So today, what we are seeing here is a market that has been trading sideways for a while and now may be destined for a potential break. So the breakout on gold would be happening, let's say above this area here. So this is what we are seeing here, a very strong consolidation and a potential break towards the upper side. So once we have evidence of a break, then the potential for bullish momentum will be there. And of course, the very short-term target would be right here at 1992 price level. So we could be seeing the price of gold moving high to 1992. And of course, if we cruise above that, then the next target remains the previous high. So we could also be seeing price make a comeback all the way up to 2007 price level. So first target is 1992, second target 2007. So as for AUD-USD currency pair, what we are seeing is a strong bounce from this bottom here, which we happened to identify last week. Then after the market rallied, this week we had a nice break yesterday, and today a continuation in that direction, and we are yet to hit the major resistance level. So if I was to use this trend line, we know that it has not been hit yet. And of course, if we use this other trend line, then you can notice that this one has been broken, and there's that potential that the market could potentially reach the upper trend line all the way up around 0.64914. So we could be seeing the market going for that, but then there's also another short-term area, which was a high a couple of days ago. I think this was on Monday. 4 weeks ago, not 4 days ago. So we can already see the market finding some challenges breaking above this area. And this was an area that was acting as a resistance previously. So in this case, there's that potential that the market could reverse at 0.64437. So we just have to be observant and see what happens around that area. So for US equity indices, as I mentioned, they were pretty strong after the announcement yesterday, following a very positive comment from Jerome Powell. So we managed to have a break above this trend line for the first time in a while in the NASDAQ 100. So after the market kept following this trend line, we saw the breakout happen. And now we might be headed for another upswing towards the upper trend line, which is still bearish. So the upper trend line is right here. So this is the highest we have seen on the NASDAQ this year. And this has remained a key theme in this particular market. And of course, if you are to look at this, then we would say that it has also been bearish following this path. So it's a bearish channel on the NASDAQ, and now we are on our way up. So we could be seeing some further upside happening on the NASDAQ before more bearish momentum comes into the markets. So for now, it's a bullish momentum, and now the potential for the market continuing to go up leads to the belief that we could be headed for this high that we just saw recently. So for today, we are seeing a market holding steady for a while and then making a break towards the upper side. So since, let's say, midnight, what we are seeing here was more of a sideways momentum. And right now, the market is breaking higher. So the potential for a further momentum upside towards 14,847 seems more playable. And of course, for the US 30 is a similar thing. More upside momentum is expected as we continue for the day. And of course, for the US 500 or the S&P 500, there's still more potential for some further upside, with the target being 4,266. So as for oil, it has really struggled to find a bottom. So it keeps on going down, especially since the top that we saw 2 weeks ago. So last week was largely bearish, this week largely bearish, and we are seeing the market attempting to bottom around this area here. But then we don't have any evidence of a strong bullish momentum. So from what I'm seeing here, if I was to remove everything, clearly, this seems like a continuation of the same bearish momentum. So if I was to use a trend line here, it would probably pass through this area here. And if I did this and then extrapolated, then you can see there's still more room for the upside on oil prices, but the real opportunity is on the downside. So if price keeps on going down, then that's when we identify our opportunity. But then also this support level is quite significant. So for today, I expect the market to be forming some continued rally. So we could be seeing oil prices getting to the upper trend line. So also notice this area and the way it was acting as a bottom, it has the potential to be the resistance for the day. So in this case, if price keeps going up, then the potential for getting to 86.547 seems quite significant. And of course, once we get to that area, we observe what happens with price before making a further decision. So European equities are currently pretty strong in line with what's happening with the US equity indices. So for the French 40 index, what we are seeing is a very strong momentum towards this trend line, and perhaps even a break is in the books. So in this case, the current candlestick is clearly a break above that trend line, which indicates a reversal and a continued bullish momentum. So a continuation of the upside is something to expect. So from the previous low, which was right here, it seems like a nice target for the CAC 40 is around 7,094. So USDCNH, dollar basically losing to the Chinese yuan and now making a recovery. I expect some further upside going through the day. The Euro 50 cash index is also pretty strong on the upside. So from the forward chart, this is how it looks like. And if I zoom out and then try to determine my trend line here, then it's clear that we could be seeing some further upside here towards this trend line. So these are trend line here. So it's almost hitting that area, but we have already seen the French 40 index basically break above that line. So we had an inverted head and shoulder pattern here before the market went back to retest the area and then rally all the way up. So now a potential swing trade could be identified from this area once we see evidence of bearish market entry. So for the FTSE 100, we are seeing a very strong bullish momentum from the London index. So clearly, we are testing a previous level that was acting as a resistance. So from the forward chart, this is how it looks like. So it's a market that is basically reversing. The previous lows have already been breached in the current candlestick, and further upside is expected. So a nice target would be a previous swing high. And in this case, we are looking at 7,518. So there is still more room for the upside on the FTSE 100 index. So in this case, I expect equities to remain bullish for the day, and perhaps the biggest upside potential is on the UK 100. So Bitcoin has remained pretty strong after ranging here for quite a while. I remember mentioning that this is a major resistance level. So it was broken last midnight, and now the potential for further upside momentum remains significantly high, since now we have a direction in Bitcoin. So New Zealand USD is one pair that made a nice break here, pulled back, and now maintained some further upside momentum. So whenever you have a pattern like this and the market breaks towards the upper side, you look for the base of the pattern, where the pattern started, and this is 0.59288. So in this case, I expect the market to continue pushing higher. So as the market pulls back here, we are looking for evidence of bullish continuation, and then we continue trading higher towards the target of 0.59288. So that's it from my side. Let me check your questions, guys. So when actual data is less than forecasted but higher than previous, how do you expect market to react? Or like a case we had on CHF rates. So when you say data is less than forecasted, it basically means that it missed the expectations in the market. But then if it's higher than previous, then you need to look at the overall picture. So I don't know how to explain this. Let's say we are looking at a stock. So if this stock is reporting earnings and you're expecting, let's say $2, and the company reports earnings of, let's say, $1.8, but then when you look at the previous data, it was $1.5. You know that the earnings are currently improving, but they are not improving as the market expects. So if the market is expecting that the earnings would be, let's say, $2, and it misses this and reports 1.8, then you know that investors have already reacted to their expectations. So for the investors who are expecting the earnings to be $2, they already bought the stock. So in this case, you see the overall reaction in the stock price. So instead of the stock moving higher, you'll find the stock moving further downwards, mainly because it missed expectations and people had already placed their positions based on their expectations. Hello, J Squad. Thank you for joining the session. Hello, Caspar. If you are late for the session, always know that the sessions are live and recorded on YouTube. So immediately after the session, you can access it on YouTube and you can gather all the points that you may have missed before. So are the markets pricing in a recession with a higher for longer narrative by Fed come next financial year? So from what we are seeing, there are two angles to this. So on one side, the Fed, which is the central bank of the US, is basically tightening policy by hiking interest rates and keeping them higher for longer. On the other hand, there is a lot of stimulus coming into the US economy as deficit spending keeps on increasing. So from the fiscal spending, it's way higher than expected. So the government is spending a lot more money, which basically strengthens the economy. And as a result, the talk about a potential recession is off the books. So right now, the US economy is pretty strong. Jobs are at an all-time low or close to all-time lows. basically meaning that the potential for recession is currently very low. So we are not seeing any form of recession happening as far much as mid next year. So what does a rate hike do to the market? So a rate hike basically increases interest rates, and this has the result of also increasing the yields on bonds. And as a result of that, people and investors tend to push more currency into the bonds. So for instance, as Kenyan interest rates have continued increasing and hit 10.5%, this has also increased the yields on bonds. The current infrastructure bill is expected to be around 16%. So a lot of banks and individuals as well as corporations are investing their money in bonds. And when you invest in a bond, you get a bond certificate and the money goes to the government, which means that there's less money circulating in the economy. And when there's scarcity of money, it basically means that money gains value. So it basically slows down the inflation. So whenever there's a rate hike, it slows down the inflation and the currency tends to strengthen. And that is why we saw the dollar weakening when rates were held, or was it other reasons which you might highlight for us kindly? So markets were focused on the Jerome Powell speech. So from the Jerome Powell speech, he has been pretty hawkish for the better part of the year. And by hawkish, it basically means comments that are indicating further tightening of the economy. But then from yesterday's comments, he's majorly neutral, but he doesn't open up for the downside. So investors know that interest rates are not about to be cut. They don't have an idea of whether Jerome Powell will hike on the next meeting, but they are very confident that the interest rates will stay high. So as a result, there was a slight disappointment leading to a sell-off in the dollar. But then knowing that interest rates have remained high and may continue being high for a longer period of time, then that's why I have this expectation that the dollar index will make a recovery, especially today after the big sell-off yesterday. So we could be seeing the dollar index make a comeback from this area and start moving higher. And from that, it would imply selling pound USD or even looking for sales in Euro USD and so on. Hello, Robert, and thank you for joining the session. Possible play of pound USD from the Bank of England. That's an interesting question. So for me, I'm focused on this particular trend line as a key price level. So if we happen to see the price get to 1.220227 or thereabout, then this is the key decision point. So around this area, if price gets to that level, then this is the projection. The previous high is somewhere around here. So this is the high that I'm talking about. So a surprise rate hike would see the pound immediately jump all the way up to this area and perhaps even higher. And that higher would basically suggest also this other previous high. So we could also be seeing price moving higher and getting to 1.23359. On the other hand, if there is a dovish comments from the Bank of England Governor Bailey, then a big drop towards the previous low to correct some liquidity below 1.20367. So by zooming out, you'll notice that this is quite a clean support. So if it's a hawkish, then we go up. If it's a dovish, then we could be seeing the market even going to retest some previous lows. So it could establish a new trend towards this area. And this basically means the market basically dropping all the way to 1.18477. But then on the short run, we are basically looking at 1.20367. So from the 1 hour chart, this is how it looks like. So I'll try to zoom out. So here's the previous bottom. There's also this other bottom. So if you get to this bottom, we may as well go to this one. So my projection is we go to 1.20367. Uh, analyze the voting casting by MPC of BoE. I think I've already done that. So the projections are clear. We are seeing the potential for two more members turning. So in the last reading, there was 5 versus 4. 5 going for holding interest rates, 4 for a rate hike. So in this case, there's expectation that 2 members on this side flipped and now are supporting holding interest rates steady at 5.25%. So that's why we are having this expectation. However, if there's a surprise, then go for 5.50. But then there's a very strong likelihood, especially following the other central banks, that the Bank of England decides to hold rates steady. Hello, I'm having a strong around how will gold react on that. Of course, we know that gold is usually used as a safe haven asset. So higher interest rates or higher for longer interest rates basically implies that there will be more investors going for the dollar or even the pound for the higher yield. And that would mean less demand for gold. So in this case, higher for longer would basically imply that there's less demand for gold and gold continues moving downwards. However, from a technical perspective, what we are seeing here is gold breaking towards the upper side, meaning that it's strengthening against the dollar. And you can see the correlation yesterday. In the evening, gold was strengthening, whereas the dollar index was basically moving downwards. So in this case, this opposite correlation implies that gold still has more room for upside before we see some changes happening in the markets. So in the short run, 1992 is a nice target for gold, which is yesterday's high. And once we get to that, and the Bank of England announces its decision, if there's more hawkishness indicating further rate hikes, that would be negative for gold. And if there's a dovishness, then that should be very positive for gold. So that's it for the day. Thank you very much, guys. And I hope to see you on the next session. So remember, the newest episode of the Bullish Panther podcast is out. So make sure to listen on your favorite podcast platform. So you can also listen to it on YouTube. Just go to FX Pesa YouTube, click on podcast, and then check out the latest podcast. So that's it for the day. Thank you, guys. See you in the evening. We will be having a session at 8 p.m. And that's what we basically describe as the Market Pulse series, which happens every Thursday at 8 p.m.